guys. Today we try to see what are the different types of traders. Okay, we have generally about four types of traders. The first one is what we call day trader. Okay. Now, what is a day trader? A day trader is a professional that buys and sells stocks daily. Daily, what does it mean? It means when the stock market opens at, for example, from 9:30 to 4 o'clock, this is generally where the day trader work. It means they buy and they sell during this time. Either you can use what we call a time frame. You can use 1 minute or 2 minutes or 30 minutes or half an hour or 1 hour. It depends on the type of day trader you are. And when you buy and you sell, usually to capture just few cents or maybe sometimes to some dollars in the day. It means if the stock, for example, is like 20.33, this is he buys the stock of, for example, 20.33. Now, for example, if it is 20.50, he will sell the stock. It means he will sell very quick. He doesn't wait that much long. But it could be, it depends on his time frame. Sometimes people, they use a chart with 1 minute, sometimes 2, sometimes 5, sometimes 10, 30. It depends on the trader himself. Okay, those guys, they are what we call professional. It means they have experience. They have large amount of money. Okay, those what you call sophisticated. It means they have a very large sum of money. They have experience, and they use different techniques in order to get a profit during the day. Okay, before 4 o'clock, they stop trading. They will sell all their stocks, all their securities they buy during the day. Now, why these day traders, they stop after 4? They don't do trades after 4. Just when the market is open. When the market is closed, they stop trading. Now, these people, they don't like what we call night shock. What do you mean by this night shock? It means they want to see how the stock is going up and down, fluctuation during the day, but they don't want to let their money or their shares at night, because in the next day, for example, the stock stops at 4 o'clock, 4 p.m. For example, it is 2060. Okay. Now, the next day, suppose that there is bad news or there is something happen, and in the morning it becomes, for example, let's say $15, because there is like bad news for the company, or there are any other reason for the stock market, and the price goes from 20.60, it goes down to 15. So these people, they lose a lot of money because they buy a lot, and they don't want to lose that much money. So what do? They stop trading after 4. So they will sell. It means they want to control more their money, and to be present when they do trade. It means it's like a professional job. A person who comes to this to online in order to do some buy and some sell like this. So they buy, they sell, they buy, they sell as they want, and at the end of the day, they stop everything like trading, and this is what we call a day trader. Okay, this is in general day trader. Now we go to the second type of trader, which is number 2. This is what we call swing trader. Sorry for the handwriting. So swing trader is a trader who buys for a few days to some weeks. Okay? So most of these people, they want to see what we call a short-term trading. Short-term trading. It means if the stock is 20 today, and they think the stock will go to 26 or 30 or something, there is a possibility. The stock goes. So they buy from here, and they wait some days to some weeks. Now, when the stock will go down, will begin down, they will sell. They buy here, they sell here. This is their plan. Okay? This is their plan. How do they do it? Most of these guys, who's a swing trader, they try. For example, if you see the chart, the stock in the chart, it goes like this, it goes like this, it goes like this. So they try to time the market, and they buy here, they sell here, they buy here, they sell when it goes here. So they always sell and buy according to the chart. But these guys, they don't stay long. It means for 6 months, 1 year, 2 years, 3 years. No, they just few days, some weeks, and then they stop when the stock goes down, and they begin to lose some money that the profit that they had, they begin to lose. So what they do, they stop here, and they take their profit. Now, if the stock from 20 goes to 19 or I don't know 80 or something, they just quit because it's not good for them, because they go long, and the market is against them, so they sell. That's it. Now, this is what we call a swing trading. They just swing like a zigzag. They go long, and they can go short too. But okay, this is in general. Now, number 3, they are called position trading. Position trading. Now, this or a position trader, since we say types of trader, a position trader is someone who buys the stocks for a longer period, for few weeks to few months. So these guys stay longer than the other. Now, they are following what we call trends. A trend like this. They want to buy here and to stay. They know that the stock goes, and some people sell like this. They go up and down a little bit. They go up like this. Now, this is what we call a trend. So they don't fear that the stock goes down a little bit. For example, here is 20, here is 25, $25, it goes to 23, but it goes to 27. So you see, up, down a little bit, up, down a little bit, and this is what we call a trend. So they want to capture a very large profit from the stock. This stock is going for a trend, and they just want to take too much money, but they should wait. So they should wait so long, few weeks to few months, and they trade by trend. Okay, some people they use what we call indicators. Some people they use averages. You know, it's just a way to do the stuff. So this is what we call a position trader. They should have a very large sum of money, and they should wait until they get a good profit. So, and the last one, which is number 4, this type of trader is called an investor. An investor is a trader who thinks that the company stock will go for good, and he needs to wait for the stock for many months, 2 years, to eternity. Why I say eternity? It means they have the stock for a very, very long time, from months to years to eternity. Now, these investors, they should know a lot about the company. They should know a lot about the company they invest in, about the company. Okay? If the company is making money constantly, it means making each year, each quarter, their earnings is going up and up and up for many years, and it is a big company. Most of the time, the investors they invest in big companies, and they are with these companies for the long run. Okay, for the long run, it means they want to invest because they know a lot about these companies. These investors usually they have large amounts of money, like millions of dollars or more. So they buy a lot and they stay. Some of these investors, so suppose for example, if you take Apple or Google or other companies, some people when they buy, they will never sell, because they know that these companies are going for good, and they are what we call growth companies. It means when they always will have growth, so they just go for the company. Not just because they like the company or they like the products they have, but because they know there is a very large potential of money. I will tell you just an example. Now Google was trading like $10, like maybe 8 years or 10 years ago. Now it is about $650. You see, those people, when they invest in these big companies, when they were young until they become mature, like now, they are making a lot of money. And if they see that the companies, any company of those or any other company, they are beginning to lose money, a lot of money, and they see that there is like problems with the company. I give you an example of companies that they show, like for example, Bank of America. 2 years ago, it was like nearly $46. Now it's trading $10. So people, some investors, they take their money from this company or this bank because they see that the company loses money for the long run. So it's not a good idea to stay and hold your shares in some of the companies. Like, this is just an example. There are a lot of examples. When you see a company that for some months or some years going down like this, from here, like 46, now it is 10, you know that this company has a problem. So it is not a good idea to hold your shares. What you call here, buy and hold. Buy and hold the shares of the company. So it is not a good idea to buy and hold shares for the company that it is losing business. When the company loses business, there is no money coming or little money. So the investors, the big investors, they quit. They go out of the company shares. That's why you will see that there is a decline, a regular decline. You can see like this. But still, when you see the trend, it's going down for many months or many years, and it's going down. And you don't know where it will stop and go up. So we don't know. So that's why these investors, they stop buying, but they sell their shares. Now, this is in general the types of traders. So if in the future you want to trade stocks, to buy shares of the companies, you try to see what is convenient for you. Are you quick in order to do what we call day trading, because it needs quick decisions? Or are you like an investor? You study the company first, and then you invest some money and you leave it for months or years, and then you check if it is good or bad. This is what the people do. Okay, thank you very much. If you have any question about this or about other videos, please comment on my videos. Thank you very much.